In this video, I'm going to talk about how the auditor would go about testing the effectiveness of a client's internal controls for inventory. Remember, we've been talking about the 6 different steps for auditing inventory, and in our last video, we talked about how to evaluate the design of the client's internal controls. So we first had to understand what controls were actually in place, and now what we're going to do is test the effectiveness of those internal controls. Now, why does this even matter in the context of the whole audit? If you remember, audit risk is a function of the risk of material misstatement and detection risk. Risk of material misstatement is not under the auditor's control. Detection risk is under the auditor's control because it's a function of how much they do in terms of substantive procedures and substantive testing. So when it comes to the risk of material misstatement, remember that it is a function of inherent risk and control risk. In other words, the higher control risk is, the more the auditor is going to need to decrease detection risk, which is under the auditor's control, in order to keep audit risk at an acceptable level. So when we're talking about testing the effectiveness of these internal controls, ultimately, what we're trying to do is figure out what control risk is for this client, which would affect the risk of material misstatement, and then help the auditor understand how much they have to do in terms of substantive testing to keep the audit risk at an acceptable level. So that's what we're doing here. Now, remember, the auditor needs to determine whether each control is operating as designed and being performed by someone who has the ability and authorization to actually perform that control. So just because a company says, look, we have this procedure, we have this internal control in place, that doesn't mean that it's effective. Effective means, okay, you have this internal control, but it's being operated, and it's being operated by someone who knows how to operate it, and they're authorized to operate it. So that's an effective internal control. Now, how does the auditor go about testing the internal controls? Well, there's multiple things they can do. Number one, they can ask questions of management. Now, this is helpful when you think about something like variance analysis. So variances, ideally, would be analyzed by the company's top management, and then they would go and investigate the source of large variances, whether it's price variance, quantity variance, and so forth. So the auditor can go and talk to upper management and ask them, okay, what kind of variances have you had? Have you seen any trends in the variances? Are you investigating them? What are the sources of the variances? And so on. The auditor can also observe the client applying the control. An example of that is the auditor watching the client's staff count the inventory. I can't tell you enough how important it is, the physical count of the inventory. Now, it would be very unusual for the auditor to be counting the entire inventory of the client, right? That doesn't happen. The client is responsible for counting their own inventory. But what would happen is the auditor would observe, they would watch the client actually performing the physical count to see, okay, they missed something, or they're doing this, they're doing that. Also, the auditor, and we'll get into this in the next video when we talk about substantive procedures, but the auditor would go and do sample counts, right? They would do test count of a portion of the inventory and then compare that to what the client came up with and see if there's a significant discrepancy. So the auditor needs to watch the staff of the client count the inventory. Now, in terms of inspecting the client's documents, this would be things like you're checking for authorization, like, okay, there was a purchase order or there was a requisition of raw materials into production. Did somebody authorize that? How would you do that? Well, you check for signatures on the documents. Also, you can check that reconciliations were performed. Maybe we're talking about like the usage of raw materials and how much was scrapped, how much was actually used in production, and so forth. The auditor can check to see, okay, was there is there some evidence there actually was a reconciliation performed? Did somebody actually sign off on this material being transferred and so forth from one department to another? Reperforming the control. So the auditor could go, so the client should be doing this, but the auditor could go themselves and check for missing documents in a sequence. So if we're talking about like material requisition forms, and ideally they'd be pre-numbered. So let's say you say, okay, well, we've got number 202, number 203, number 205, number 206, and then the auditor can go and check and say, hey, wait a minute, we're missing one. Where's 204? Right, that's not showing up in the system. So that's something that the auditor could check. So this is just high level, some things. We'll get into more detail in a minute. Now, in general, this is just talking about tests of internal controls in general, not specific to inventory. Ideally, the auditor, whenever possible, would do dual direction tests. When we talk about testing in both directions, here's an example. So if we think about management's existence assertion, so they're saying, hey, the inventory actually exists. It's not just in the records, just bogus inventory. There actually is inventory. And then we talk about the completeness assertion, making sure all inventory has been recorded. You think about how do you have a dual direction test? Well, the auditor going and vouching back. So basically, vouching back is going and saying, okay, look, in the records, it says there's some inventory. Now, where is that inventory? Let me go find it in the warehouse. I'm going to go and find it in the records and then go backwards and see that they're actually, oh, I see it here. It's on this shelf. Okay. Tracing forward would be the other direction. So that would be, you go all the way back to, like, let's say the original purchase order, and then you follow that all the way through the system. There was a purchase order, then the inventory was received, it was put on the books and so forth. So you can go both directions. You can go and say, all right, I'm going to start with the inventory or the accounting records and then go back and find that inventory, see if that inventory is actually out on the shelf somewhere, and go the other direction, start with the initial purchase of inventory, then go forward to the inventory being received and ultimately recorded in the company's accounting records. So that's what I'm talking about with dual direction tests and being helpful. Now, as I said, you need to make sure that the client is physically counting the inventory and checking into the sources of any discrepancies. When I say discrepancies, what I mean is a difference between the inventory balance per the physical count, like we went out and we counted the inventory and here's what we got, versus the inventory per the accounting record. So inventory per the books and inventory per the count. If there's a difference, management should be checking into why. Now, there's so many different reasons that there could be a difference between the physical count and the accounting records. People stealing the inventory, could be employees, could be customers. Recorded inventory is being received, but we didn't actually get it. There's issues with scrap. We didn't record the scrap and so on. I'm not going to get into all that. As you know, there's many different ways. The inventory could be different from what we actually have on hand and what the accounting records say. So now what I want to get into is I want to give you a bunch of examples, ways that the auditor would go about testing the internal controls for the client. Now, you see there's a lot here, so hang with me. This column here is the assertion being made by management. So they're asserting that, we've got inventory transactions. That's what we're going to talk about first. We'll talk about inventory balances later. This is all about inventory transactions. This transaction actually occurred. Oh, the company said there was a purchase recorded. Did it actually happen? Did that transaction actually happen? Oh, they said there was production. Did the production actually occur? So that's the occur. So we got this column is the assertion being made by management. Here's the potential misstatement, okay? And then we've got the internal control. Now, we talked about these internal controls in the last video when I talked about evaluating the company's internal controls. So this is not new information. If you haven't seen that video, I encourage you to do that. So what I'm going to be talking more about is this column, the test of control. So this is what the auditor could do to go and say, okay, so we've got this internal control. How do I go about and test that? So I'm just going to go through a few of these. Segregation of duties, not just with inventory, but with anything. This is absolutely critical when we come to internal controls. When we think about sequential numbering, so sequential numbering, whether it be purchase orders, material requisition orders, receiving reports, anything, there needs to be a sequential number, and you need to see that the client is actually going and checking for missing numbers in that sequence. Just because they use pre-numbered forms doesn't mean they're not going to be any problems. Are they actually going and inspecting and saying, hey, you know what? I checked this every month and I just caught that there's multiple receiving reports that are not accounted for. In terms of reconciliations of what the amount of raw material that was issued for use in production and what was scrapped. Is someone reconciling that? Is there someone saying, hey, wait a minute, actually, was this material scrapped? I don't know what happened because we issued this amount and then this amount. So is someone actually accounting for this? Again, just because the client says they have a procedure for this doesn't mean that they're actually doing it. So you'd like to see some kind of reconciliation, and who is that reconciliation performed by? So did somebody actually do this, and if so, who? So you can verify that this is actually happening. When it comes to to observing the client, comparing, for example, receiving reports to respective purchase orders. So, okay, we at some point had a purchase order, and then at some point the inventory actually received. We fill out a receiving report, and we can watch the client actually compare those reports and verify that someone at the client who's authorized to do so is actually comparing those, right? They're comparing and saying, okay, here's what we purchased, here's what we received. Is there a discrepancy? Did we account for everything in terms of the completeness? Now, thinking about authorization, is there a signature for someone who's not just a random person, but an authorized person? Is there a signature when we're thinking about purchase orders, receiving reports, when we actually get the inventory, transfers of raw materials into production? Maybe there are some unauthorized production going on. And so is there somebody at the client, and we can observe, we can go and see, is there someone actually at the client that is checking for authorization? And can we find, as the auditor, some kind of evidence that there is authorization? Or is it just, no, people produce inventory when they want, and nobody's really checking into this? Now, when we get about, I talk about variances, I mentioned this before. Remember, price variances, quantity variances. Oh, we're paying a lot more for the inventory than we thought, or we used a lot more inventory than we thought to produce this product if we're a manufacturer. Are they actually doing the variance analysis? And then on top of that, look, anyone could just go and calculate a bunch of price and quantity variances. Is management actually investigating the cause of any large variances? So if we have a significant variance, are they going and looking into it? Because remember, a variance is just a red flag that says, hey, there's a potential problem here. Why don't you go check this out? If nobody ever checks it out, it doesn't matter that they calculated any variances. Okay, so the auditor needs to go and get some kind of evidence, and that's where we get into inquiry. They could talk to management, ask them what kind of analysis they've done. When it comes to cutoff, where it be purchases of inventory, sales of inventory, remember, we got to check the dates. If they've sold inventory, they're saying, oh, we sold this inventory and the cutoff date was December 31st, and then we see that the inventory wasn't shipped out till January 2nd, right? That's a problem in terms of cutoff. So we can go as the auditor, and we can go and check these dates. Ideally, the client is doing that as well, but we can go and we can check the dates and see whatever internal controls they have. Are they actually catching any issues with cutoff? We don't want the client holding the fiscal period open an extra few days to count more sales or something like that. Okay? Some of that we cover, of course, in the audit of the revenue and collection cycle. Here I'm mainly focused on purchase of inventory, but sales of inventory matter as well, right? And they're also going to affect cost of goods sold. So when we have the transfer, if you think about a manufacturer, the material, it goes from raw materials, and then it goes into production. It's work in process, it's finished goods. So you have the product moving from department to department. Okay, the inventory is moving throughout for a manufacturer. Is someone actually approving the transfer of that inventory? Can we get some kind of evidence that there's some kind of control here of when the inventory moves? Because anytime the inventory moves, there's a chance it could be stolen, right? Remember, inventory, there's always a chance it'll be stolen. It could also be lost or something as well. Now, all those assertions we just talked about, tests of controls for inventory transactions. Now we're going to talk about tests of controls for account balances, right? So now we're talking about the inventory balance. So we said the client's asserting, hey, we have a certain amount of inventory on our balance sheet. They're asserting that inventory actually exists, right? They're saying there actually is inventory, that it's just not just some number on a balance sheet. So segregation of duties, as always, very critical. We cannot have the same person doing multiple tasks. That opens the door to fraud, right? They purchase too much inventory, they pocket some of it, take it home and sell it on eBay, and then they report that they received a different amount, or maybe they say some of it was scrapped, or whatever, right? They'll find a way to go and steal inventory if we're not careful. Related, we need to make sure inventory is secure. Is it just that it's unlocked area and just anybody can go and get the inventory? The auditor can go and check. Where's the inventory stored? The auditor can just go walk in and take some, right? If that's the case, that's a problem, right? We want to make sure it's in a locked area. There's the security camera. Someone's actually monitoring the security cameras. Like there's some kind of way to prevent people from stealing inventory. Now, in terms of the physical count, remember we said the client is going to be counting that inventory. They're going to count all the inventory, but the auditor needs to watch them. They need to watch them performing the physical count and see, okay, do they look like, let's say you say, yeah, we do a physical count. And then the auditor follows someone around as they're counting and they see, man, that person is really not doing a good job with the count. They missed that. They missed that. They didn't count this. They seemed distracted. They were playing on their phone half the time, whatever, right? So that's a problem. So we need to make sure the inventories count. But the auditor, again, is not the one counting all the client's inventory. They're watching the client do it and see if there are any kind of problems. Now, when we think about valuation assertion, which is another critical one in terms of inventory, we don't want the inventory on the balance sheet being overstated, overvalued, okay? And reviewing what are the procedures for taking an inventory write-down. And is someone going and actually checking? Are they going and saying, you know what, I looked and I saw a lot of inventory is just old, is dusty, has been sitting a while. We got some inventory in the corner of the warehouse that's been there a long time and I don't think anyone's going to buy it. Is somebody actually doing that? Are they checking for obsolete inventory? Or is it like, no, we got this warehouse, we got the inventory, we don't know what's going on with it, right? So we need to be reviewing whatever the client's procedures are for inventory write-downs and see if they make sense. Are they going out and actually verifying that we don't have obsolete inventory or inventory that is broken or something, or somehow needs to be written down? Now, when we come to job cost sheets, if we're talking about manufacturer that uses job costing or checking for signatures, so again, this comes back to when we think about like, okay, approving a job cost sheet, how much, remember, job cost sheet is going to have direct material used, direct labor, and it's going to have manufacturer overhead applied to that job. Okay, is there someone actually that's approving these job cost sheets and stuff, or do we have just ridiculous amounts assigned to job cost sheets and nobody ever even looks into it or cares? Now, so that's a bunch. So then, we had our tests of internal controls for inventory for account balances. We had for transactions. Now we say, okay, we've done all that. Let's say you've done all that. You say, now what do we do with this? What do we care? What the auditor needs to do now is go and look at the planned level of control risk, like what we originally thought, like we had some idea of what control risk would be. And now we know the achieved level because we've actually gone and tested the effectiveness of all these internal controls. So now we know and we say, okay, look, this is control risk, right? Because remember we said audit risk was equal to risk of material misstatement, which is inherent risk, times control risk, and then, so this here is the risk of material misstatement from the beginning of this video, okay? And then we had detection risk, which is controlled by the auditor, right, based on how much substantive testing they do. Now we know what this is. And we already did inherent risk. I talked about that in another video. So once the auditor knows this, right, now they can say, okay, what do we need to set detection risk at to make sure audit risk is at an acceptable level? And how do they set this detection risk? They're going to say, okay, if the control risk is a lot higher than what we thought, if it's like, man, you know what? I went and looked at the controls for this company and how they're operating them, it's a problem. The control risk is high. Okay, then we're going to need to decrease detection risk. How do we bring detection risk down? Okay, we're going to do it by increasing the number of substantive procedures. So basically, the higher the control risk is, the auditor's going to have to compensate by doing more substantive procedures. However, if it turns out actually control risk is lower, actually the controls are operating better than what we even thought, then we can afford to do fewer substantive procedures. And I'm going to talk about substantive procedures in the next video.